should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you. On Money Friday, this is Your Money, Your Call.
And welcome to Your Money, Your Call. It's the Bonds edition. It's Friday night. I'm Mark Todd from the NAB. I'm joined by Chris Black in Melbourne. He's with Alexander Funds, and Dan Miles from Innova Asset Management. They're here to answer any of your questions. Feel free to call us. It's 1300 30 34 35. The email is yourmoney@skynews.com.au. We have a couple of emails already, which is great. So they came through in the course of the week, so we'll talk about that. But first, we'll talk. Dan, you've been on before, and it was warmly received, so you're back again. But for those who are new to the show, who haven't seen you on the show before, tell us about Innova Asset Management. What is it you do, and how do you go about your business of doing what you do?
Sure. We're a global asset allocation or multi-asset investment shop with a particular focus on risk management. And we think risk for investors needs to be looked at in a number of different ways and managed in a number of different ways. And we primarily use asset allocation to control for that. And we essentially manage the money and implement on behalf of advisors and their clients.
And how is business? I mean, in a world where everything's, well, until Donald Trump tweeted that he was the most harassed president ever, and then he obviously fired a lot of people that probably some people don't think he should have fired or whatever. So the volatility that he created. Prior to that, most assets seem to be going all the same way. So the asset allocation story works well when things are volatile and some assets get sold off and you can show that there's a performance. When it goes all the same way, how are the clients reacting? What's the tone coming from the customers?
I'm getting a lot more of the relative return focus. So you quite often talk about people being, absolute return on the way down and relative return on the way up. And in the last 8-9 years or so since the GFC, there have been a lot of people who have been very focused on capital preservation. That has really shifted. There's a lot of people focused on relative return, how they're going versus the market. As an asset allocator, you're right. It's a tough environment in which to invest in because nothing is glaringly cheap and a lot of things are expensive. And things being expensive in and of themselves is not that big an issue if you can find stuff to rotate into. But it's very difficult when everything's expensive. I mean, you're not even getting a premium above inflation for cash. So, cash is not even a great place to own assets. We've made some, we've made selective calls. We've been quite fortunate that we've gotten a lot more right than we've gotten wrong, which has been good. So performance has been a lot better than I would have expected in this sort of environment. And in some senses, that makes me a little bit nervous. I hope there's not, risk in the portfolio that I haven't, foreseen or thought about.
And before I go to Chris, one final question. What's the performance been? Can you talk to a number?
High and low double-digit returns depending on the amount of risk that's been taken.
Yeah, right. Chris, welcome. How are you?
I'm well, Mark. Thanks.
Tell me about, you've been on, you're a regular, and we love having you on. We always look for new insights in what's going through your mind. So tell me a little bit about, everyone knows Alexander, but let's just have the 30,000, the elevator, conversation. How's business? What is it you're looking at, and what's been happening?
Business is good. The fund's up to 130 mil now. We're growing fairly rapidly, and coming up to the end of the financial year, we're targeting 7 to 7.5%, which is, we think, a very good result for our conservative fixed income credit fund.
Sharp ratio. Do you want to walk the viewers through the 7% return, and we've got Dan talking about taking greater risk, maybe getting some higher returns. Part of the story at the moment has obviously been volatility. What's the Sharp ratio look like on the performance of the fund?
Yeah, it's very high, and of course the Sharp ratio is your returns divided by your volatility. So to give viewers at home an idea of the kind of volatility we've had, the last couple of years we've produced returns of around 7.5%, so roughly about 60 basis points a month, and our returns over the last 2 years have ranged from 40 basis points a month to 80 basis points a month. We haven't had a negative monthly return for more than 5 years. So that's, you know, when you're producing returns at 7.5, that's one thing, but producing them on such a consistent basis, that's what investors are
Chris,
really enjoying about our fund.
Fair income boring. I mean, seriously, you are not doing the job I wanted you to do, which was to make fixed income sexy. I mean, that is so boring. Can you not do that? Let's try and do that again.
We're just, we're you know, we're like accountants. We're pretty straight-laced, and but I tell you what, it's nice being in fixed income when the markets are a little bit volatile. I sleep pretty easily at night.
I bet. Dan, you know, we're 4 months into the Donald Trump presidency. We had, I mentioned at the start, we had, you know, President Trump's capacity to create volatility in markets is obvious. We knew it was going to happen. But where to from here? Like, what? I guess I wonder how the central bank response is. Like, what happens from here? Do you continue to see greater volatility, or does the weight of money just squeeze the heat out of the system?
Yeah, I just quickly correct one thing I said before. I meant to say high single-digit, low double-digit returns. Pardon me. Right. Look, I think central banks will continue to squeeze volatility out of the markets. Where do we go to from here? I don't know where the path is going to be. What I do know is that I have a pretty high level of confidence that returns are going to be pretty poor over the long term, and a lot of asset classes, like US equities, for instance. Where do we go from here? The loony bin? Didn't we, prior to Trump coming in, weren't we worried that he'd be completely mad as a president? Now he's in, he's even more crazy than we thought. And yet markets take one day to kind of jump at the idea of impeachment, and then they rebound the following day because all of his ideas are not off the table. This is just a bizarre scenario in which to operate. I guess the only explanation is central bank intervention, is it not?
Yeah, well, Chris, what do you think? In terms of the Trump presidency and the like, is there something to be said for the fact that he's creating volatility in markets but not impacting them in any meaningful manner? In other words, because he can't execute, the machine just continues to roll on, and to some extent it is central banks that just look at data and they're just running around with cash and saying effectively the legislative platform won't come into fruition. There will be very little that he will do as a president.
Well, I think that's what the volatility was exhibited over the last couple of days. But I think the market over the last, say, 18 months has shown that it's got little time for geopolitical or political issues. And I think the real volatility will come when we get potential inflation in the US.
If it isn't, so give me a sense of what worries you. You know, if it's not the geopolitical challenges, and bear in mind that France have solved for the way markets wanted it to happen, it looks like Angela Merkel is getting some confidence around her electability. So Europe seems to be working its way through some of this stuff. So what do you think worries you right now? What's keeping you, if it ever, you know, I know you've got this dull old quiet portfolio, mate, but what worries you or what keeps you awake at night, if anything at all?
Well, it is that it is potential for US inflation. I think, you know, we've over the last 5 or 6 years, asset prices have gone through the roof. The US S&P has got higher and higher. The PE ratio of that index is at nosebleed type levels, and that's in our mind mainly due to quantitative easing and low rates. So as soon as you start reversing that, you're going to get a hit to asset prices. So we're looking at the US labour market quite closely, and we think that if there is wage inflation, that's when you start to get volatility. So that's the thing that we're most focused on. There's a whole lot of other issues that we concern ourselves with, but that seems to be the key in our world at the moment.
Thank you. I suppose that we will talk before, hopefully before we go to an ad break. We've got an email on the CPI as it relates to Australia, so there is something about that we want to deal with. But in terms of your fears, what fears do you have in the market? You know, there would be frustration with the market. But is there anything that worries you? Yeah,
it's prices, and in fact, Chris articulated it quite well. It's not that I have a fear of heightened inflation in the States. I don't have a clearer crystal ball than anybody else, but it's not in the price of assets. 10-year US Treasuries are trading at, 2.25, which is around about what the US long-term inflation target is. So you're not getting any inflation premium whatsoever to take on 10 years worth of inflation risk. That doesn't sound like a particularly attractive deal to me. And that's nothing compared to Japanese government bonds or European bonds, which are paying you essentially nothing. And here in Australia, we've got the 10-year US Treasury is now at 2.48, smack bang in the RBA's target range. You're getting essentially no inflation premium whatsoever. So I'm not predicting inflation. What I'm worried about is that the market's essentially priced in a zero probability of any inflation over the next 10 years, and that just does not sound like an intelligent price from my point of view. That's what keeps me up. So
without worrying the viewers too much, where is the low-hanging fruit? Is there any low-hanging fruit?
The Indian rupee? No, look, I don't think there's a lot of low-hanging fruit. I think there's relative valuation attractiveness. So I don't think the people at home need to be too worried about it. Not many people at home are going to be buying 10-year government, Commonwealth government securities. They're probably going to own Australian equities, residential property or commercial property. They might own some credit securities. So the types of things that Chris owns, I think, are a lot more attractive than the longer duration stuff. Australian equities are mildly expensive, but not outrageously expensive. Asian equities are not expensive. They're not cheap, but they're not expensive by any stretch. And the global economy is fine. The global economy is doing perfectly well. It's just the prices have more than factored it in. That's what worries me. So I'm not concerned about the economy. It's prices of markets that worry me.
We'll go to our first ad break for the night, and then we'll come back and see where Chris can find some low-hanging fruit. And we'll talk a little bit more about inflation and CPI and what it means to Australia. Talk to you soon.
Earn 80,000 bonus points with the new NAB Rewards Platinum card, which you could use with Webjet for a return flight from Sydney to Auckland.
Clever you.
Or a $400 red balloon experience.
Clever.
Or choose from hundreds of items in the NAB Rewards store. New NAB Rewards. A clever little card.
Clever.
NAB. More than money.
Chic Hydro versus a lube strip. With 7 hydrating gel pools that give you 40% less friction. It's designed like no other razor to protect from irritation. Chic Hydro. Free your skin.
If your home becomes too damaged to live in, Budget Direct will provide temporary accommodation for you and your pets for up to a year. But not everyone's a Budget Direct customer.
It's not small. It's cozy. If anything, we're all closer now after the incident. I mean, sometimes I can barely tear you guys apart. Whoa! Hey, easy, big fella. Group hug? That's good.
Do you get up to a year's temporary accommodation? Get more with Budget Direct.
Dreaming of controlling your own retirement funds? A self-managed super fund with eSuperFund means you can choose where to invest your super, with benefits including tax breaks and a wide range of investment options. Sound complicated? It won't be with eSuperFund. We'll guide you the whole way. We're one of the largest SMSF providers in Australia, meaning you're in good hands. Go to eSuperFund.com.au and find out how you can save with our limited time offer.
Things are done differently around here. Abbott's Village Bakery loaves are free to enjoy all of this. We only ever feed them the good stuff. Just grain-fed. We just let nature do its work. Oh, but Frank's pretty handy to have around too. We raise them free-range, so you can taste the difference. Introducing Abbott's Village Bakery Harvest Pumpkin and Sunflower Seeds.
Cruise Europe's rivers in style for less. Evergreen's 15-day deluxe river cruise from only $5,145. Early bird deals won't last long. Hurry, call your Evergreen expert today.
Earn 80,000 bonus points with the new NAB Rewards Platinum card, which you could use with Webjet for a return flight from Sydney to Auckland. New NAB Rewards. A clever little card.
Clever.
NAB. More than money.
Dreaming of controlling your own retirement funds? A self-managed super fund with eSuperFund means you can choose where to invest your super, with benefits including tax breaks and a wide range of investment options. Sound complicated? It won't be with eSuperFund. We'll guide you the whole way. We're one of the largest SMSF providers in Australia, meaning you're in good hands. Go to eSuperFund.com.au and find out how you can save with our limited time offer.
Welcome back to Your Money, Your Call, the Bonds edition, Friday night. I'm Mark Todd from the NAB. I'm joined by Chris Black in Melbourne from Alexander Funds and Dan Miles from Innova Asset Management. They're here to answer any of your questions. Feel free to call us, and I would recommend you call 1300 30 34 35. The email yourmoney@skynews.com.au. Chris, can I just get your sense of where you see some low-hanging fruit, and we'll take our first email for the night after that one.
Okay, so where we see low-hanging fruit is in the private debt space, actually. The credit markets can be hugely inefficient, and we've been doing some direct lending to microfinance companies that where we get huge amounts of subordination and still can return, 10 to 12% on those type of loans. So that's great business for my investors, and it's an area that we're going to continue to pursue. And
it's one of those things where you can get smaller tranches, smaller outcomes. It's not a leverageable business. It's something that, as a fund manager, I'm guessing that you say, look, that's my value add, and therefore it can be a bit more targeted. Yeah, very much so, Mark. We target sizes of up to 5 to 10 mil. There's not too many players in the market that can lend or are willing to do the work to lend out that much. If there's a microfinance company that wants to borrow 40 or 50 mil, they'll go to NAB Private to try to get a deal done. But if they want to borrow 5 to 10 mil and the banks aren't working with them, then we're perfect to fit into that space. 40 odd million will be welcome with open arms. We have our first email from the night from Ashish. And Ashish asks, why does the rise in house prices and its associated costs not considered or not be considered in calculating the CPI, while the rent increases are considered for CPI? After all, this is a major portion of living costs for first home buyers for the duration of the home loan term. And there's a second part to it. Does it not mask the true cost of living? How can inflation go back to normal levels if households spend most of their income on servicing their huge home loans? Ashish, the first part of it is, in terms of the CPI, they do take in the costs associated with the building, the dwelling, but they don't include the land, the rates, and things associated with it on that front. And I guess that's because the statistician has never done it. Well, actually, they did it once, and then they were criticised for the fact that they were chasing CPI. Monetary policy was chasing CPI, trying to solve for it. We need it to be higher, so therefore we'll include these other things. So that's the reason why, but I want to get the viewers to talk to me a little bit about, and I'll start with Chris and then come up with Dan. How do you think that plays out in the market, Chris, around the fact that, Ashish's point is, if we're spending so much of our money because interest rates are so low, the quantum of loans are so big and the funding going out is so massive because you need to get into the market, that there's not much money to spend on inflationary objects? What do you think? Well, that has some truth to it. I think I think that inflation in Australia will be fairly low as a result of that for a long period of time. But there's other factors that influence inflation. I mean, I think Dan was saying before that we have, the exchange rate has an impact on inflation. If you have a sell-off in the Australian dollar, all of our imported goods go up, and that then feeds into the CPI number. So, Ashish, at the moment, there's a whole array of different things. Generational movements, we're getting older, low rates, not much growth, not really massive growth, and really poor wages growth that is compounding the idea that inflation will stay low. So you're right, there's some asset appreciation if you're in Sydney and Melbourne. If you're in Darwin, Adelaide, Tasmania, you're probably not seeing the same sort of level of growth. You might see some. But Dan, the question for you is, with interest rates where they are in both the United States and Australia, what happens if they go in the US to a tightening cycle, tightening bias? We don't move. Their rates go above us. What happens in your mind to our currency and therefore then the inflation that Chris was mentioning that you talked about?
Okay, two parts to it. The short answer is it's entirely dependent on what the market thinks will happen to our rates going forward. My opinion is that it'll be almost entirely linked to terms of trade. So if commodity prices stay higher for longer, terms of trade turns. The comment about there not being enough disposable income to be able to be spent on goods to spike up inflation is absolutely correct for roughly half of what drives inflation. What's little understood is that there's tradable inflation and there's non-tradable... Sorry, there's tradable goods and non-tradable goods that are roughly 50-50 as part of the CPI calculation. And I'm not an economist, so I don't know the exact numbers off the top of my head. But the non-tradable component is what we're referring to. The tradable component is imported. Prior to 2007-2008, we had wages growth of around 4-5% per annum, but our inflation was only roughly 2%. Why? Because the tradable component was only about 1%. We had this deflationary effect. Well, now we're not getting any wages growth whatsoever, and the tradable component is not up around 4-5 to off-balance it so that we get up around the 3 or 4. If something occurs in the exchange rate, so if the commodity prices stay low and our exchange rate drops, we could see a massive rise in import costs, which could lead to an increase in inflation. That will obviously crush the value of the Aussie dollar. What could happen, though, is if the Asian economies boom and demand for resources spikes. We had the Australian economy piggybacked off the back of the resources boom up until 2008. We've now piggybacked off the East Coast, mainly Sydney and Melbourne, residential property boom. Who knows? Maybe it's another commodity cycle. I don't know. That's what could lead to a levelling, but we could end up seeing the Aussie dollar crushed.
Chris, are we looking at stagflation if we talk about the first piece that Dan mentioned where the currency's down, import costs are massively increased, and we don't have the offsetting rise in economic activity? Is that something that we need to think about and say, okay, if our currency, if our interest rates are effectively below the US, and it's only happened I think twice, it doesn't often happen, and the currency did get smashed, is that something we need to think about, that stagflation story?
Look, stagflation is a term that's used for quite a narrow economic environment. I wouldn't call it stagflation. I can't see a situation in Australia where we get significant inflation. I think we're likely to get, and in fact, I don't think we're likely to get much inflation at all. I think in the US we might get some wage inflation without any growth, but that's not necessarily stagflation in itself.
We have our second email from the night. It's from Peter, and Peter's saying, I'm managing 10% of my super in stocks and hybrids. The balance is invested via a platform in managed funds across cash, alternatives, property, fixed income and shares. I'm lacking investments in infrastructure funds. He asks, what are the benefits of infrastructure and what are the factors driving the returns? What is accessible and what are the signs to watch out for when entering the market? I know Pete. Pete's a good bloke, and I think he's, by the sounds of it, and I'll start with Dan, he's got a pretty balanced portfolio. How does he get into infrastructure, and to some extent, how do you think about infrastructure? Because I think we need to radically rethink about what infrastructure is, because often we think it's just a road or something.
There's a couple of different ways you can get access to infrastructure. So there's managed funds. You can use active or passive. There's at least one infrastructure ETF that I'm aware of that's available on the ASX. If you are going to invest in a passive form of infrastructure, there are three main indices that are used, but all of them, in my opinion, are structurally flawed in their composition. So spend a bit of time looking into it. Or if you're going to use an active manager, there are plenty of good ones that are domestically based, or you can use an offshore manager, but do the work first before you allocate to it. There's a pretty broad question as to how you think about infrastructure. look, you could use simple things as to whether you want to allocate to it or not. You could use simple things such as yield compared to market historically, enterprise value over EBITDA, margins. Generally, I would recommend if you're going to be allocating to, not that I know this person's circumstances, but if
Pete, we're not giving you direct advice.
No.
So, Pete, you've got to go and get your own advice, and we'll go to an ad break in a minute, and then we'll talk to Chris about his thoughts on infrastructure. But
yeah, generally I would allocate globally because it's very limited domestically, and then you need to have a think about what you're going to do in regards to your currency. Usually most people use a hedged version so they don't have to worry about the currency fluctuations.
And there's a couple of platforms, Pete, like Benelong, and I've got some friends that are doing global infrastructure in that front, and I do think one of the ways that I'm now thinking about infrastructure, we did NextDC as a bond. So, and I'm not saying buy that, but looking at that technology, which is cloud computing and the way cloud's growing, I start to think of NextDC, Cube. I start to think of those organisations as infrastructure. The telecommunications of the world. They were talking last night about Cube. The Moorebank deal in Cube, the size of it is from it's 2.5 miles by 2 miles square. It's just enormous, and so that's the infrastructure story where they'll take 1,000 trucks off the road per day. So they came out with a bond, a sub-debt bond at 390 over, and people were buying it with their ears pinned back. Chris, we'll come back and chat to you first about what you think about infrastructure and some of the ideas you might have about entering into that market. We'll take our second very hard ad break for the night.
We know you've always worked hard for your money. Isn't it time your money worked hard for you? Invest with La Trobe Financial, trusted by Australians for more than 60 years and judged Money Magazine's best mortgage fund 8 years in a row.
The world is full of hidden treasure, just waiting to be discovered. So look a little closer and see what others don't. Join Expedia Plus Rewards today and discover member pricing and more.
The Ford Mustang Shelby GT500. Build a unique 1/8 scale replica of the classic American muscle car. Get issue 1 with your first model parts at newsagents now for just $4.99. D'Agostini.
I used to make great decisions. I'd never turn down a better deal. And if someone could do the job for me, I wouldn't say no. So when I learned that UNO's algorithm and their team of experts could get me a better deal on my home loan, woohoo! Well, you know what I did. Yeah, you do. Cheers. Oh, why'd I buy a kayak with the savings? Hello?
John Wick. The man. The myth. The legend.
John Wick, Chapter 2, in cinemas now.
Where's the best spot to dive in?
I know just the place.
Somewhere only we know.
We're leaving our generation to join one that's moving us forward.
Our garage business can go global.
A new generation, where it's easy to pass on our skills.
Where our crazy ideas become crazy reality.
We're doing things differently, seeing things differently, and we're just getting started. It's time for a new generation. It's time for Gen MBN.
Dreaming of controlling your own retirement funds? A self-managed super fund with eSuperFund means you can choose where to invest your super, with benefits including tax breaks and a wide range of investment options. Sound complicated? It won't be with eSuperFund. We'll guide you the whole way. We're one of the largest SMSF providers in Australia, meaning you're in good hands. Go to eSuperFund.com.au and find out how you can save with our limited time offer.
Welcome back to Your Money, Your Call, the Bonds edition. I'm Mark Todd from the NAB, and I'm joined by Chris Black from Alexander Funds and Dan Miles from Innova Asset Management. If you want to email me directly, it's mark.todd@nab.com.au. We're here to answer any of your questions. Call us, 1300 30 34 35. The email, I'm sure you're aware, yourmoney.skynews.com.au. Chris, you're not an infrastructure guy, you're more an RMBS guy. When somebody comes to you about infrastructure, do you just push them to somewhere else, or how do you think when they talk about that, you say, look, there's a lot around, go find it yourself?
Well, you know, certainly there's some quasi-infrastructure in the corporate bond space. I think you'd mentioned Cube before, which we invested in. It was a listed bond, and it has been very successful, but primarily it's not my space.
And there's also, we did Pete. You know, Pete's, that's massive infrastructure. That's you know, they're land banks, you know, so if that's not infrastructure, I'm not quite sure what it is. So, Pete, maybe there's an idea that you can get, there's some listed stuff coming out, you can maybe start making part of your more concentrated direct investments in some of the infrastructure trades, and then you could look at it from a perspective of, am I being compensated for a long-term return? Some of those returns were, you know, 390 and 400 over. Chris, if I can stay with you, one of the things that I capture with Pete's email is the passive versus active debate. And I guess I'd like you to make the case for the active, because the passive, when it comes to organisations like Vanguard, and I'm talking about this ad nauseum, they are the Uber of financial markets. They are crushing the world. I don't know if that's necessarily a good thing, because anyone crushing the world isn't a good thing. So active versus passive. Chris, tell me about the version of you, why active works for you.
Okay, so firstly, the equity markets and the credit markets are completely different beasts. What I'm saying in terms of the credit markets doesn't necessarily apply to the equity market. So if I invest in equities, it's likely to be a passive investment. In the credit markets are hugely inefficient at times. It's an over-the-counter market. There can be a real lack of transparency, and that creates inefficiencies. And and there's also huge technical factors that drive the market at times as well. And that's where managers' experience within the market, being able to identify relative value, really does add a huge amount of alpha to a portfolio. And that's played out in our returns versus, you know, the returns of the indices that you have.
Well, you said indices, mate. I was worried you were going to say that name a fund manager, and that would have been very embarrassing. So thank you for saying indices and not a fund manager.
Well, I could have to be cheeky.
Don't be cheeky, please. It's live TV. Active, passive. You had a piece of paper there.
Mm-hmm.
How many metrics do you look at when you're trying to find value? How many did you say it was?
Just over 160 that we look at on a weekly basis.
Right. So that's quite active.
Yes.
Help me understand how you think about active as a value add, because you're looking at all the indices, all the asset classes. And give me an example, one that you might look at that people don't necessarily think about.
It's very hard to find like, how do you really invest in a properly passive asset allocation? I suppose you could do a 70-30, but that's not market cap weighted. That's just kind of happened by default. So I don't really have a passive index that I could invest in anyway, even if you wanted to do what I do. So there are a bunch of indices we look at. We have a lot of people talk about the cyclically adjusted price earnings on market multiples. You know, you could look at price to book. We look at an EBITDA normalised trend number that most people wouldn't look at, and price numbers compared to that. And the US looks very expensive on that. The US looks very expensive on most multiples.
A normalised EBITDA on the basis of what? Normalised, what are you taking out?
Normalising it throughout a cycle. So if you have a look at the earnings profile of you know, a basket of companies, like the ASX 200, for instance, you see the earnings growth cycle almost to the 8-year number that you get in your economics textbook. So we try to normalise for those cycles, because if you're at the peak and you've got price divided by a number at the peak, the number's going to look artificially low. Whereas if you look at price versus the trough, it's going to look artificially high. We want to have a look at where it's going to normalise to, and understand what price is relative to that.
Sure. We're about to talk budget, and Chris, we have a caller on the line, so I think I'm wanting you to answer this one, because you wanted to chat about the budget. How can we help you? I haven't got your name yet, I'm sorry. Hi, Chris.
Chris, Mark.
Hi.
Hi. I was just wondering if you guys know, with respect to the bank levy, whether it puts Australians at a disadvantage with respect to interest rate payments against foreign investors or foreign people buying Australian property, because they may be borrowing from their own lenders in their own countries at much cheaper interest rates, and therefore they can obviously put forward a lot more than us. I was just wondering if that's real or not.
Okay. I think I can cover that one. So the challenge... So what happens is, when you buy Australian assets, you need Australian dollars, and I'm not being facetious. So the offshore lender has to actually lend to you at the Aussie rate. They have to do the foreign exchange. So if they've got Swiss francs, they've got to bring it back and convert it. And so that conversion, that FX differential, creates the interest rate rebalancing. So the truth of the matter is that the majority of people that buy Australian property from overseas probably don't borrow that much, if at all. And a lot of it is about the transfer of cash into assets that they think there is some value, or there might be a role for that money other than movement of assets out. It might be for movement of family in, because there's education, there's all sorts of benefits of being in the country. But in terms of its impact on the Australian property market, it's not the cost of borrowings, it's the desire to be here.
No, you're right. That interest rate differential is referred to as carry. So if you were able to borrow in US dollars as an Australian, then you converted it back, or you deposited in US dollars at 1%, you converted it back to 1.5%. As you said earlier, the Australian interest rates have almost always been higher than US. There's almost always been a positive carry. It'd be a strange situation if there was a negative carry.
Yep. Chris, walk me through your thoughts on the budget and its ramifications for investors. I know that the banks have been at pains to say consultation helps to solve for some of the pain, and there was a lack of consultation, and it's not obvious that the government wants to consult. They want to, I don't know, chastise? I mean, is that the right way to describe it? But they're happy to have the fight. It sounds like it's a good political fight for them. What's your interpretation of the budget and its impact on investors?
Well, look, we were talking about the bank levy, and certainly that may impact investors. When you've got over $6 billion that are getting charged to the majors, they've got to find a way to absorb that. That's going to be through efficiency cost savings at the bank level, through passing it on through their mortgage business, or through their dividend through the dividend policy. I suspect it'll be a combination of I don't think efficiency gains are going to be great, so I suspect it's going to be a combination of increased costs to households through their mortgages, and an impact to investors through lower dividends.
Yeah, I'm not going to disagree. The only point part of the problems are, Dan, that the banks don't know what the impost is. It's hard to work it out. They're asking the government for answers. I work in banking, so, okay, I'm going to be biased. It's hard to work out what to do, but it's fair to say that if you pay more tax, it can't stay within the organisation entirely. It has a ramification. It either means we all lose our jobs, and therefore, people are desperately unhappy, or we don't make as much money. And if we don't make as much money, we can't pay dividends. So I don't know that it's easily solved around just shouting at us.
Yeah, look, if we think of it a different way, before the bank levy was imposed, I was writing a few things to our clients, and I was saying, look, we need to have serious thought about Australia's AAA credit rating. And Chris Joy has written about this as well, if anybody's read his stuff on the AFR. If Australia loses one notch off its AAA credit rating, that's likely to lead to one notch being knocked off the bank's AA credit rating. Now, the banks are very reliant on overseas funding. If that one notch comes off their AA credit rating, their cost of borrowing would go up. If that cost of borrowing went up, they wouldn't be expected to wear it. They would pass it on to consumers in some way, shape or form. The bank levy can be thought of in the same way. It's essentially a tax to try and ensure that the government can tell S&P, Moody's and Fitch that, hey, we will bring our budget back into surplus at some point in the future, even though I actually don't think it's within their control. I think it's the global economy that will do that, but that's a long story. It's an impost on them to try and keep the AAA credit rating. If we lost that credit rating, their cost of borrowing would go up. They would pass that on. You know, it'd be pretty unrealistic to expect they're not going to pass on at least part of it, given that it's just been lumped on them.
Chris, how important is the AAA credit rating, to Dan's point?
Well, I think it is important. I mean, the talk is that the increased cost to the banks is around 20 basis points. So the bank's rating, as Dan said, is linked to the AAA rating of the Australian government. That gets downgraded. The senior debt of the banks goes from a AA- rating to an A+ rating, and that's worth 20 basis points in the institutional market that then feeds through. So it is important.
I think one of the things to think about for the viewers is just the size of the global markets that the banks need to participate in. So last night, I'll come back after the ad break, I'll look at the actual numbers, but last night NAB issued $3.5 billion. So in other words, they borrowed $3.5 billion in the US market. They did it in a night. Those markets are incredibly efficient and they are looking for credit. So I recognise everything you're saying is true. There would be some challenges in those markets and you need to be able to explain those markets.
Correct.
And I don't think we have yet got to a stage where everyone understands how the banks fund themselves. We just look at the end result, which is the profitability.
Look, I think the reality, I don't know the exact numbers, but I think the banks borrow about 2.5 to 3 times the volume offshore that they have in domestic deposits.
Yeah.
If the cost of that borrowing goes up by, as Chris said, 20 basis points, I mean, we're talking 6 now, because we're talking wholesale funding. The 6 basis points is on wholesale funding. All of that is wholesale funding. 20 basis points is a lot worse than 6.
Yeah. We'll take our final break for the night and we'll talk more about billions of dollars and how it relates to you as investors.
The Macca's Homestyle Angus Burger, part of the new Gourmet Creations range, now available in drive-thru. It's the fast, easy way to gourmet.
It takes a unique perspective to see the whole picture. Chartered accountants help businesses to seize opportunities, prepare for future challenges, and grow industries that can contribute to healthier economies. Choose a chartered accountant.
Farmed in harmony with nature.
Dad, when's dinner?
Because at Continental, we believe that real, sustainably grown ingredients taste great.
Here's your new Golf.
It's hard to let go of a good thing. The Golf Run Out, yours from $22,990 drive away, plus an impressive $2,000 factory bonus.
Volkswagen.
If your home becomes unlivable, Budget Direct will provide temporary accommodation for up to a year.
It's not small. It's cozy. Right, guys?
Do you get up to a year's temporary accommodation? Get more with Budget Direct.
Schick Hydro versus a lube strip.
with 7 hydrating gel pools that give you 40% less friction. It's designed like no other razor to protect from irritation. Chic Hydro. Free your skin.
The world is full of hidden treasure, just waiting to be discovered. So look a little closer and see what others don't. Join Expedia Plus Rewards today and discover member pricing and more.
25% off everything at Freedom. Only for My Freedom members. Join now, save now. End Sunday.
The Macca's Homestyle Angus Burger, part of the new Gourmet Creations range, now available in drive-thru. It's the fast, easy way to gourmet.
Welcome back to Your Money, Your Call, the Bonds edition. I'm Mark Todd from the NAB. I'm joined by Chris Blake from Alexander Funds, and he's a good-looking bloke in Melbourne, and Dan Miles from Innova Asset Management. He's here on my right. I'm not saying he's not the good-looking bloke, but he's on my right. It's our last segment for the night, so be quick if you want to call us, 1300 30 34 35. Email yourmoney@skynews.com.au. If we don't get to that, we'll get to it next week. So the majority of portfolios are made up of property. This is a question for you, Dan. Property and equities, that's what it is. It's everyone's got it. Holds about 61%. Will that ever change? And why should it change? It's made people a lot of money. It's all fine.
I think it should change. We've got a demographic shift with an ageing population, and not everybody can have all their money in assets such as property and equities and deal with the capital volatility because, you know, they may not have enough money that they're able to just function off and live off the yield of those assets. They need to draw down on the capital. And if they're drawing down on the capital at a time where markets fall, that capital's been expended. It's not there to bounce back. It's not there to ride out that wave. So I think that with the shift the boomers into, you know, a time of their life when they're not working anymore and drawing down on that capital, it makes sense to have assets that are, you know, income-yielding assets with less capital volatility.
A bit of fixed income. Chris, I know that you think that everyone has got too much in property and equities. I know that. We all know that. But how are you going to change this view? I mean, help me understand what the catalyst would be when people say, well, I've done pretty well out of it. Why do I need to change?
Look, there is a movement occurring. I mean, we're seeing it in inflows in the Alexander Fund, but it's going to take a lot of time. And we've come from a base where equities and property have been so attractive. We haven't had a recession here for 25 years. We've got, you know, huge, large dividends on equities. I mean, those two asset classes have been wonderful asset classes to be involved in. I think the change really hits home when we get some volatility in the market and people start to lose money on those positions. I know, and I've said this in the past, I know as a portfolio manager, you really get to understand risk when you've lost money on it. And I think that change occurs when people lose money on it. And then there's a long way to go because our SMSF investors out there only have 1% allocation to fixed income credit.
So hang on a second. I've got a question there for you. I've got two questions that I want both of you to answer. But I'll stick with you, Chris, right now. If the Australian investors have only got 1% in fixed income, let's say they decide right.
That's SMSF investors.
Sure.
Overall, institutional investors have about 15, I think.
Yep, sure. So let's say those investors, of which that is the fastest growing investor pool, if they decide to move into fixed income, they're all watching this show, they go into fixed income, where are we going to find the bonds? If they go to take 10% fixed income, where are you going to find the bonds?
Well, I think there needs to be encouragement for a kind of a more active and stronger bond market domestically. Certainly there's tax things, kind of moves that the government can make to make fixed income more attractive. But I think ultimately, you know, it's a mindset move by investors, but also companies. If there is more demand for fixed income bonds, companies will come to the table as well. In Europe, if you're a company and you're looking to raise money, if you're a small medium enterprise and you're looking to raise money, you think about raising it in the fixed income bond market before you go to your bank and before you go to the equity markets.
Okay.
And in Europe, investors hold about 45% of their portfolio in bonds. So it goes hand in hand with kind of increased allocation.
One sec, Chris. I'm with you on all that, except Europe is a great place to holiday, and a lot of people get really arced up about telling them how to manage. And I'm with Chris. I think we need greater fixed income. But where are you going to find it? What's the idea around this? And I will make the point that I think I know the answer. I'm just waiting to see if anyone else knows it. We did Next CC, I mentioned. That was $300 million in one day. I think that market is evolving. Cube that Chris bought, I think there was $1 billion in one day in bids. So I think banks may not have to fund overseas $3.5 billion in the US market because we might start to replicate it here. But where do you think we get the bonds? I think
a couple of places. The most obvious place to me is from government issuance. They're going to have to fund a $75 billion infrastructure spend from something. Infrastructure is quite logically funded by bonds issued to the market. You know, we had a government prior to 2007 that extinguished our deficits, and so we essentially had no debt and therefore no bonds. We're now in a situation that we need debt, so we can issue bonds there. But then you've just highlighted the other area, corporate issuance. If corporates are able to get access to debt at very low these are generational lows that they're able to get access to debt at. Institutional investors like me are there looking for opportunities to provide them with debt funding because the price of most other assets is not particularly attractive.
Chris, we're getting wrapped up soon, but I want to get your ideas on systemic risk. If you mentioned the fact that if people lose money, they are more attuned to the risks associated. How, as a professional, do you manage the risk that is in portfolios? How do you manage systemic risk? What do you do? That's
a good question, Mark. So there's really two risks within my portfolio: the idiosyncratic or bottom-up single credit risk, and macro systemic risk. And we have to be conscious of that because, you know, if the Australian stock market fell by 20%, then credit assets would naturally fall. They fall by a lot less, but we run an absolute return portfolio, so we don't care. We're agnostic as to the direction of the markets. We're promising our investors that we're trying to make money in rising or falling markets. So the way we deal with it is we look to hedge it. We look to increase our hedge when we think there's greater likelihood of volatility in the near term.
Dan, how do you manage risk in your portfolio? Is it driven by the fact that you think it's a balanced... Not that you think, that's the wrong way, but you make it a balanced portfolio, therefore that manages the risk because you can't be perfectly hedged, or how do you think about it?
People talk about common portfolio construction technique is, you know, buy cheap, sell expensive. What they don't talk about is the other one, which is allocate more and concentrate to your best ideas and diversify when there's not that much upside, not that many good ideas. So we try to balance that component with very different sources of risk. And when there's not that much upside, we own as many as we can. And when we find things that are very attractive, that's when we concentrate the allocations.
Chris, what about sequencing risk? How do you think people are thinking about that? Do they pay enough attention to it?
No, not at all. I think it's a real downfall of the Australian investor that I don't think people understand sequencing risk or the implications of it. I think Dan alluded to it before, but people don't realise that they might have to access their cash in a year's time or 2 years' time. So you can't buy a stock that's a proxy for fixed income and think that you don't need to get access to the capital until kind of 10 or 15 years' time.
Your thoughts on sequencing risk?
It's not well understood at all because people have a short memory. I mean, we know that as investors.
They still think about the GFC, don't they?
Some do, but it was 8 years ago. It's becoming a faint memory. And Chris has just talked about hyperbolic time anchoring. People put off things tomorrow that they can get today. And so, no, sequencing risk is not particularly well understood and is not particularly well managed, even amongst professionals.
Chris, I just want to wrap on you. Duration. Do you think people consider the duration they need to invest for when they consider the liabilities they own? Do you think anyone talks about that as well?
Sorry, you asking from a portfolio, from my consideration of duration?
No,
or,
just
or
the general.
investor?
The SMSF investor is buying 90-day TDs and they're going to live for 30 years and they won't invest longer than 1 year.
Yeah, look, again, it goes hand in hand with the sequencing risk concept. Is that I don't think people are planning duration or matching of assets and liabilities particularly well.
Thanks, mate. That's all we have time for in the show tonight. I want to thank my guests, Chris Black from Alexander Funds, Dan Miles from Innova Asset Management. To you, the viewers who've called and emailed, that was great. I'm Mark Todd from the NAB. Have a great weekend. All the best.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.